users, but at some point you need to come up with cash or you go bankrupt. So this is assuming that cash is the most important. And the second thing is really about time value of money. Now, this time value of money, there's two components. One is if you sell it to something, if I give you money today, right, in the bank or whatever, I would hope to get something more in return later on. So that's one for one, because money tomorrow is worth less than money today. So there's some kind of discount. So that's one component. Two is, if I buy something, you're going to pay me back for the period. I better get something in return during the meantime, right? If I'm buying for something and you're giving me back something in the end, there better be an appreciation. So this is the analysis portion, and you can ignore the details on this. Just treat this FCFF as some kind of free cash flow. This is some kind of cash. How do you come up with that? There's a lot of calculations behind it, but basically it's the same thing as this, as forecasting. We're taking a view and how much cash the company is going to generate in the future. So this is still estimates, but we're using cash instead of earnings. And there's some kind of discount, because I'm saying, if I'm going to put my money into the company today, I'm not buying goods for myself. So there's some kind of trade-off, so I need some kind of gain. Right? So there's a discount factor. So money that you as a company would deliver to me in the future, I take a discount because it's worth less to me. It's not worth a full dollar. And the terminal value is saying, in the end, I'm assuming that you hold it for either a month, a year, maybe 10 years. At some point, I'm going to sell it. Right? So that's just in theory. But that terminal value, you can treat it as if there's some kind of growth rate in there. So growth becomes an important factor in looking at a company. But because this is a very broad overview, so we won't go into details. But it's just important to know what goes into it, and so that when you do the technical analysis portion, you think about these things, right? What is essentially a good company? Because if trades can occur on bad companies, I'm not talking about short sell here. So you can buy bad companies and still make money, but that's probably not going to last for the long term, because other people are going to realize it's a bad apple, and they're going to start take the opposite position, and maybe you lose money. So it's important to know what good companies are. And knowing what good companies, one is intuitive, right? You think about it, okay, what makes a good company for you? Right? What do you think is a good company? Or you can look into financial theories and say, okay, I know that terminal value, the formula has a growth rate, so growth is important for a good company. So this is just the driver behind it. And the trading portion of this analysis is also very simple. So if you take the discounted present value of all these cash flows, you get some kind of value per share. Okay? So you compare it to today's price. If the price is higher or lower, you make your decision based on it. So again, and why is this flawed? Again, it's also flawed because you're still making forecasts, and timing-wise, it's not so great because these reportings, you're looking more backward, even though you're forecasting into the future. So the information you get is already pretty old by the time you're doing the forecast. So maybe the marketer knows and you find the price. So fundamental analysis in this case is not really doesn't really become a good predictor. Okay, so we've taken a look at these both of these methods, and it's really just to show you how it's done in practice and the theories. And I think fundamental analysis is a good intellectual exercise rather than taking it into practice. There's a few conclusions from this. It's from the modeling side. One is the easier the model, the fewer errors you tend to make. So if you're really going to commit to using some kind of fundamental analysis to at least cross-check your technical analysis or when you do technical trading, it's important to say that make your model as simple as possible. I know a lot of people do multiple analysis, multiple iterations, something called Monte Carlo analysis, which is simulations. You can get very complex, and people, at the large institution will say, well, that's great, that you know how to do all this. Well, in the end, you keep it simple so you make less errors. And a complex model doesn't necessarily become a better predictor than the simpler ones. And the quicker the method, the more practical. And the preference is probably towards the relative valuation rather than this, because there are two things. One is it's quick and dirty, right? Using the multiple is really simple. You look at Bloomberg, you look online and look what the analysts trade at the forecast in terms of the average multiples, and you just use that number to say, okay, what is the next year's income? You ask management in an investor meeting, and they'll say, okay, I think it's this X, and you just do a quick calculation. But for this method, you need to spend at least a day to put it. Even if you have the existing model, maybe a couple hours to do it, right? You can't do it within a few seconds. So people still tend to like using multiples, and especially for high. You'd be surprised how many, because I was involved in more on the investment banking side doing deals, and you'd be surprised how many CEOs would talk, amongst them when they do deals privately. They would just say, how much is your company trading? And they would talk about things like that in terms of the companies they want to buy. So very top, the leaders of today's business world are still looking at multiples as a good benchmark to make investment decisions. Doesn't mean that's the only thing they use, right? They, of course, get banks to do this for them and use all the methods, and those are to cross-checks. And these values become important because the other day, I met someone from the investment banking, and they did an internship, and he was telling me, well, we build all these models, but they don't really, they look nice, but in practice, is that really important, right? And I explained to them, well, in a mergers acquisition scenario, IPO, remember Facebook IPO, $28, I think, and then it went all the way down. Well, in that sense, that's why I think Twitter, they switched to Morgan Stanley instead of Goldman, because they're saying, well, the other way around now, because they're saying, well, you didn't price it, so the investors were pretty mad if you didn't price it right. So this analysis becomes more important on the private sense. That in the IPO sense, you need to price it at some level, because there's no market, right? You can't do technical analysis on IPOs. The share is not publicly traded yet. So this becomes important in the private sense, that you need to price it just right so that you leave some money on the table so that investors are happy, instead of selling it and then the stock goes down. And eventually went back up, but the credibility is not good. Same thing with an M&A, mergers acquisition scenario. If you want to make a bid on the company, you want to value it correctly so you're the highest bidder. Right? So you pay just, maybe the ideal case is, if you're ever in an auction, you want to buy something that's just $1 more than what other people are bidding, then you win. Right? The point is winning. And if you're the seller, you need to know what price to put out there. And imagine if you sold your car before. If you put a price online that's too high, you won't get anybody phoning you because they look at the price and just go away. Same thing with that scenario. So this analysis becomes more important in the private sense rather than in trade. So I have a couple others. So what are really the drivers for businesses? It's sometimes it's event driven, sometimes it's the company's strategy, their business model, or economic factors. And growth is an important one. So the example would be Tesla and the Asian expansion. You look at population is a good driver for them, for Tesla, and also that the eco and consumption demand. And the other one is if you look at all these internet stocks, what are the drivers? They're looking at growth for a good stock pick. So I said earlier that if I believe a fundamental analysis is a predictor, and that most active traders are just, maybe this has to do with more luck. What do I think personally is the better way of investment? I think if you look at, in practice, we're all pretty much all business people. One is to look at what's the best practice. And for me personally, I think the Yale endowment, taking an endowment approach to investment is probably the better way to go than saying picking stocks. I think that's more of a hobby if you happen to get it right. Test it out yourself and you're good at it and keep on doing it, right? For Jason, there's a lot of money for it. So do that. But for most people, it's probably not the best thing. It's probably better to go with a fully diversified portfolio and just leave your money there without worrying about the long-term trend, the short-term fluctuations. So even looking at fundamental analysis, that's the long term. But with this, you can really, you become worry-free, right? Because you're invested in the market, and you don't really care about the fluctuations or the valuation of individual stocks. So that's all I have prepared for today. And I think the key takeaway for the next session is really about, so if you can take these fundamentals, remember what are the drivers, and then when you go into the session with Jason, when he talks about how things move, and you really think, okay, I think that's a good driver in terms of the economy and how that translates to the company. I think that's really the main point. I'm not a big advocate of these in saying, okay, go out, do your model, and do your predictor, and that's how you should buy stocks. I'm just presenting what is taught in school in the theory. The theories are sound, but in practice, they're the better way to go. Thanks.
All right, thank you guys. Basically, Peter leave all the pressure to me now, so I have to tell you guys how to make money now. So, basically, for the last slide, Peter's show is basically telling you to diverse. So you can invest certain amount of money into stocks or bond or anything, right? So let's talk about some real interesting stuff. Okay, so we're going to talk about something called internal market analysis. And what does this do? It's very simple. It's time to talk about charts. What we do is we just compare a lot of charts and look at the relationship between these charts. You're going to find out what's going on with the economy. Therefore, you can position yourself for the right asset class. For example, you can invest in stocks or bond or anything, or you can buy commodity. So let's start. So basically, we have this big chart here. It's pretty messy, but it's two parts. The upper parts shows the relationship between commodity overall, which is like gold, oil, anything, and the other one is the US dollar. And the bottom one here is two things: it's government bond, treasury, and stocks. So let me talk about what's going on here. So you see right here, this is when dollar rising, and the commodities performing pretty bad. And then right here, you see dollar rising spike up here, commodity just, here, when you see a dollar crush here, commodity just go all the way up here. And then when the commodity drops, you see the dollar go straight up. So from this chart, what we're really seeing is there's a reverse relationship between the two. And why is that? Because most of the commodity are priced in dollar. So if your dollar become worth more, commodity is going to go the other way. So let's talk about stocks. Let's just focus on here. Well, what we're seeing is, look at here. We see the stock right here. It's, okay, here's the bond. Well, we see stock going up. Now it's not doing so well. And when it's going up, it's going down. So they're on an inverse relationship as well. And let me tell you why. Basically, when the economy is doing well, commodity and stocks are going up because you guys don't know, the company is going to make more money. So stock market will outperform when the economy is doing well. And when the economy is doing well, we're going to buy a lot more stuff. We need to produce more. So commodity is going to do well as well. But how come bond is not doing so well? Well, because this bond is considered as a safety asset. So what that means is you basically, if you want to get fixed income, you buy bond. But that's because you're conservative. You don't want to take any risk. And when does that happen? That usually happens when the economy is not doing so well. On the other hand, when the economy is doing well, you'll be like, okay, why do I just take the fixed income? Now I want to take some risk. I want to buy Apple. I want to buy Tesla. That's going to give me more return. So they're inversely related. And right here, this is the interesting chart. Oh, sorry. Right. Yeah, right here. So here's what I just talked about. In this period, look at that. In 2003 up to 2007, when we see stock going up, commodities going the same direction as stocks. Until one thing. In 2008, commodities still going up, but look at that. Look at this angle. It's going like straight up. And market crush. Why is that? Because we all know if the commodity price becomes so high, we have inflation. And that's going to come back and hurt the economy. So the rule is pretty simple. When the economy is expanding, when the economy is doing well, these two are going to move together to a point. Commodity become too high, it's going to come back and hurt our economy. And that, so from here, we can basically see, if you see commodity price going too high, And that's probably going to kill our economy. And that's the warning sign you have to see. And here, this is a simple chart talking about dollar in commodity. So basically, you can see the US dollar going up, commodity going down, commodity going up, dollar going down. So this is what I just talked about here, the inverse relationship here. Okay, so this is basically the intermarket analysis. And why do we want to know this? Because we want to make money. And who used this? Let me tell you, all the Wall Street people, they all know this. From 20 years ago, they've been using the same method till now. Are they going to tell you? No. Why is that? They want you to invest with them. They don't want you to be so knowledgeable, so you'll be like, okay, I don't know what's going on. Give me advice. So I can take money from you, and then they charge you a fee. And then they come back to their room, and they look at this chart, and they invest according to this. So, well, I didn't invite anybody professionally here because he's not going to be very happy to see what I just told you guys. Because that's how simple things can go here. All right, and one thing is those Wall Street people and those big financial guys, they program those charts into their computers. So the computers will do a lot of calculation, anything, and then tell them, hey, this is what we predict is going to happen. So these guys are going to invest according to those relationships. And that is the thing you guys are here for. Okay, this is a very complex thing, and it's called business cycle. And this is something you learn from your economic books, but I'm not going to go to detail. I'm just basically going to tell you the cycle things here. Basically, what's going on is here. Right here is the worst of economy, meaning recession, falling recession. Economic condition is very bad. But stocks and bonds going to start rising. Why is stock going to rise? Because from all the past experience, we know stock market usually lead the actual economy by 6 months. So if the economy hit the bottom, you're not going to figure out. But if you look at stocks is going to tell you. And to this stage is the slow expansion. But because we're still below this line, meaning we're still in recession, but we're just getting better. So in that way,